Hi guys, welcome back to the channel. My name is Dave, and today I want to twist things up a little bit and talk about KURV ETFs. Now this is a new group out of California. They've been around for about a year and a half, but their first products just hit the market late 2023. And I had the opportunity this past week to talk to the CEO and founder about this new lineup of ETFs. So let's learn about KURV. If that is what you're looking for, please stick around. Whoop. So one of the more interesting aspects of starting up a YouTube channel like this for me has been meeting people such as the folks from KURV that are bringing interesting creative products to market and understanding a little bit more about them. So when they reach out, there's no offer for compensation. There's no, we're only going to talk to you if you like what we're doing. It's really your review of their product that they're excited about bringing to market. So in this case, they called and they said, hey, we're looking for somebody that's intelligent, charismatic, can explain difficult concepts, and is really, really, really good looking. And then they said, if I know anybody like that, I should let them know. So I suppose the search continues, but enough of the bad dad jokes. Let's check out the KURV website. So they've got a nicely laid out website. They have some nice little videos you can follow along with too that will probably fill in some of the gaps that I'm going to create for you when I talk about these. But their first lineup came out late last year, October, November timeframe. So they've been around for a short period of time now. And they are based off of Tesla. Each one is an individual stock with an option overlay. So the first one is Tesla. And they've got Netflix. And they got one for Microsoft. They've got one for Google called GOOP. What a great name. Love that one. They've got one for Amazon. And they've got one for Apple. So that's their first release. They do have more in the works. They can't really talk about them until they're fully approved, but it sounds like those are going to be more broadly based. Now, these right here probably remind you a lot of the yield max ETFs, which we've talked about before. So we'll reference back to those a little bit if you're familiar with the yield max ETFs. So similar makeup to yield max with some differences that we'll talk about along the way. So let's jump in and take a look at the makeup of one of these. In this case, I picked GOOP because it's a great name and it's based off of Google, which is one of my larger holdings. And that's probably the first thing that I would say is if you're going to buy any of these, you should be excited about the underlying stock. You should want to own that underlying stock. So in this case, you should be a fan of Google if you're going to be buying GOOP, or I should say Alphabet. Now, each one of these pays out a monthly distribution, and they range anywhere from about 10% up to about 30%, with Tesla being the most volatile and offering the highest distribution rate. Pay out every single month. They have about a 1% expense ratio, similar again to the yield max funds, about the same price there. You can see some of the potential benefits: enhanced income. So really pairing these up maybe with the underlying could be something worth looking into. Offer some tax advantages, lower beta dynamic optimization. We're going to talk a lot about the options, but the options are actually managed by NEOS, which is the same people that manage SPYI and QQQI, and I'll actually be talking to those guys here shortly too. I'll have an update on QQQI coming out soon, so if you like that kind of thing, like and subscribe. But anyway, yeah, expense ratio of 1%, so that's pretty steep. So you have to make sure that, again, you understand what you're getting into up front. And for people that don't want to handle their own options, this might be a good option for you where you don't have to do that. So let's run down and let's take a look and see what's actually in the holdings. Now, each one of these will have a similar makeup based upon their underlying stock. So in this case, Alphabet or Google. And they have options or flexibility in here to either own the stock or to set up a synthetic long position. And all the ones that I've looked at so far have a synthetic long set up. And one of the reasons for that is that allows them to keep their money in cash. So you don't see any shares owned, but you do see 540,000 roughly in money market funds, T-bills, that is earning probably around 5.5% right now. So that's one of the advantages of being in a synthetic long position. And if you're not sure what a synthetic long position is, well, I'll link my video up above on the yield max funds. It goes into some nice little graphics for you that kind of walk you through it in a little bit more detail. But I'll go over it now as well, so you can, if you are into options, you probably will grasp it pretty easily. So a synthetic long position is kind of a fun options position. They have a choice. They can go out, they could buy 3,700 shares of Google, which doesn't pay a dividend, and they could sit on those shares, and that would be fine. Or they could set up a act as if I own those shares position, which is what a synthetic long is. So in this case, they get to keep their money in T-bills because they're not buying the shares, collect that 5% income, and then set up a synthetic long. So how do you do that? Well, you buy, let's suppose right now, Google is at $155 a share, just like it shows here. You buy a call, in this case 37 contracts, and you sell puts, 37 contracts, both at the money at 155. And as we know, if you're familiar with options, the calls and the puts in this case would have a 50 delta, meaning it's a coin flip, right? It's at the money. You've got a coin flip of it expiring in the money. Same with the put. And together, you'd add those together and you get 1. And anytime you have a delta of 1, you basically own those shares. And because you have a call that you've purchased and a put that you've sold, like John Travolta pointing in both directions, you're going to maintain that delta of 1. For example, if Google goes through the roof, let's say it goes to $200 a share, all of a sudden, that call is going to become very profitable. It's very deep in the money. The likelihood of it expiring in the money is very high. The probability is near 1. Let's call it 0.98, okay? And on the put side, it's very, very low. It's gone all the way up to 200. The chance of it expiring in 719 below 155 is very, very low. So in that case, it's 0.02. So 0.98 plus 0.02, you still have that delta of 1. And likewise, if it drops to the floor and goes down to 100, the same thing is going to maintain. That call is going to be very unlikely to expire in the money. The probability is all the way down to 1%, and it's 99% probability that the put is going to expire in the money. Still maintains that relationship, whether it goes up or down. It's always going to act as if you own those shares. So that's step 1 of setting up this situation here for any of these KURV ETFs. In step 2 of this option play is to try to generate income by selling calls against that synthetic long position. So in this case, they're selling calls, 5/17 expiration at a $165 strike price. Out of the money, they sold 37 contracts. They're trying to collect that income and close that out in the future. So they told me they try to target a delta of around 30, and that'll determine how far out of the money it is, and that's going to change based on the volatility of that product. Their example was Tesla's much higher. They can sell almost 15% out of the money at times, or Google might be 5%, 6% out of the money. So in this case, it's out about 5/17. They told me that it's around 6 to 8 weeks that they sell it, and they roll it out about 4 weeks into that process, further into the future, trying to collect that income. So that is their process for their options and how they try to generate income and what they hope to distribute to you every single month. We also discussed NAV erosion, which is sometimes an issue with these types of products. In this case, we're looking at the distributions for GOOP. That's the one based on Alphabet that we were just looking at. You can see the distributions have been pretty consistent as Alphabet has been pretty consistent, held up there pretty well. So 26, 28, 29, 24, 28. So some variation, but not a ton. But if we compare that to something like Tesla, which hasn't performed as well over since this product's come out, right? It's dropped quite a bit. We can see that it's been up 57 cents all the way up to 66 cents, 55, and then they corrected down to 31 cents. So more volatility in that product, but not performing as well. And they're doing some things to be cognizant of that NAV erosion and to protect the NAV of that particular product. Now let's jump over to Seeking Alpha and take a quick look at GOOP. And we can see that the inception date goes back to October 31st of 2023. So still a pretty new product to everybody. The expense ratio is 0.99%. The dividend frequency is every single month. And the yield is right around 5%. But that's not a full year. That's the trailing 12 months that don't exist yet. So they should shake out based on current performance to around 10 to 12%, maybe 1% a month. But let's compare this to some other similar products and just think about how this is working. So in this case, we've got a stock in GOOG, in the blue line, is up 22.86% since inception. And then we have GOOP doing pretty well, up 16.5%. And then we have the Yield Max version up only 3%. So how those options are managed when they're put on, time to expiration, when we roll them, all these types of decisions, you can see how greatly they can affect performance for two similar products. So in this case, GOOP is doing pretty well for a product that's rising like this. You can kind of see that those call options have probably limited the upside at times, and that's probably why you've seen a little bit of a reduction in performance versus the underlying. but it's doing okay. So again, the idea of selling calls or covered calls is something that can limit when you have a stock that really takes off. If it's trading flat sideways, then you'll get the benefit in GOOP. If it's dropping significantly, you're going to have from those calls that you're selling that you're profiting from that can add outperformance. So something to consider. Now, just to compare one more, let's look at Tesla because that's the opposite. It hasn't been on a steady increase like Google. It's been on a it's been dropping like a rock, right? So down over 20% since TSLP, the Tesla version, has come to market. So in this case, TSLP is down 16%. So you can see about 4% better performance than the stock. And then TSLY, again, similar product from YieldMax has outperformed TSLP by a few more percent. So you can see that depending on the market and what you're trying to accomplish, how these might perform in your portfolio. So what do you think about these individual stock option income ETFs from KURV and also from YieldMax? I'm curious. Let me know down in the comments below. One of the conversations that I had with them was all about how this wasn't really accessible to the retail market previously. So they were excited. That was one of the reasons they really wanted to bring these to market, was to allow retail investors to get into these. They don't have to manage the options. They're professionally managed by people over in NEOS in this case, and gives them access to that without having all the options background that you might need to feel comfortable doing this yourself. So let me know. I'm really curious myself, and I'm sure they'll be reading the comments. If you like this type of thing, please like and subscribe. Appreciate you watching. Have a great night. Take care. Whoop.